It's said that the American economy is still holding strong. GDP hasn't collapsed. The labor market hasn't broken down. Consumption, at least on paper, continues to function. But if the economy is truly stable, why are more and more American households relying on credit cards just to cover basic living expenses? Why are middle-class savings shrinking, even as macroeconomic reports avoid the word recession? The problem isn't in the growth charts. It's in rent, in medical bills, in college tuition, and in the credit card interest rates that are quietly accumulating each month. Over the past year, credit card debt and consumer loans in the U.S. have continued to reach new highs. High interest rates are no longer a policy concept, they've become a part of everyday life. At the same time, surveys show that people's economic perceptions are increasingly diverging from the picture portrayed in the media. This gap is not a fleeting emotion. It is a systemic sign. Let's put together some seemingly unrelated facts. The economy hasn't officially entered a recession, but the percentage of households living payroll remains high. Nominal income is rising, but housing, healthcare, and education costs are increasing faster. Jobs are still there, but the financial quality of life is deteriorating. As millions of Americans simultaneously withdraw their savings, borrow more short-term, and postpone major decisions like buying a home, having children, or investing in education, this is no longer a matter of individual choice. This is a collective reaction to an economic environment tightening from multiple sides. The surface numbers may not tell the whole story of the crisis. But when placed in the context of real life, a different picture begins to emerge. And when these facts are put together, a familiar structure gradually comes to light. The actual data shows that the U.S. economy still has the color of stability. Growth has not broken. Unemployment remains at historically low levels. Consumption, although slowing, has not collapsed. These indicators are sufficient to avoid a declaration of recession in the technical sense. It is based on familiar measures. GDP reflects the total value created, the labor market shows the number of jobs that remain, consumer spending is used as an indicator of the health of domestic demand. As long as these variables have not all deteriorated simultaneously, the story of no recession sounds reasonable. Within that framework, the economy is described as having a soft landing. Inflation has moved away from its peak. Monetary policy has been tight enough to curb prices, but has not caused a job shock. Large businesses are still reporting profits. Asset markets, despite their volatility, have found a foothold. All of this creates the impression that the system is withstanding pressure. But every frame has its limits. These indicators measure the volume of activity, not the quality of life. They indicate whether the economy is still functioning, not who is paying the price to maintain that function. Take the labor market as an example. Jobs are still there, but the structure of employment has changed. Growth is coming more from low-paying positions, unstable working hours, or those requiring additional work to cover costs. On paper, someone with 2 jobs is still considered employed. In real life, that's a sign of pressure. Consumption is similar. Nominal spending figures may increase, but they don't differentiate between consumption financed by sustainable income and consumption based on debt. When credit cards cover the difference between salary and expenses, the data still shows cash outflows while the financial health of the household is weakening. Even inflation, when announced as having cooled, is an average. Standardized baskets of goods do not fully reflect unavoidable expenditures such as housing, healthcare, insurance, or education, where price pressures accumulate persistently and unevenly across income groups. Therefore, the surface narrative has its own persuasive power. It aligns with macroeconomic measurement logic. It fits the rhythm of news and policy language. And it allows the system to avoid hasty conclusions. But it is here that cracks begin to appear. When the economy is judged primarily by its ability to continue running, the question of social cost is often pushed out of the picture. Stresses accumulating at the household level don't immediately reduce GDP, they alter behavior, expectations, and resilience over time. The everything is fine feeling thus exists alongside a very different experience beneath the surface. These two stories aren't immediately contradictory, they're simply discussing two different levels of the same system. And when you lower your lens to where economic decisions are made daily within each family, the picture begins to change. At the household level, the economic story takes on a completely different rhythm. It's not about graph lines, but about small, recurring decisions each month, which bills to pay first, which to postpone, and where to borrow to cover the shortfall. Nominal income may be rising, but real income after deducting unavoidable expenses is being eroded. Rent is rising faster than wages in many urban areas. Healthcare and insurance account for a larger proportion of family budgets. Tuition, student loan fees, and long-term installments remain high. These are hard costs, not elastic with market sentiment. As the gap between wages and expenses widens, the credit system steps in to compensate. Credit cards, consumer loans, and other forms of short-term borrowing become temporary bridges between current income and immediate payment obligations. On paper, spending continues. In reality, financial space is shrinking. The noteworthy point isn't a single loan, but the widespread nature of the behavior. When millions of households simultaneously increase their reliance on credit, gradually withdraw savings, and postpone long-term decisions, it's a sign of an environment forcing behavior in the same direction. The middle class, often considered the pillar of consumption, is under double pressure. On one hand, they still have jobs and income. On the other hand, the cost of living forces them to use debt to maintain their current standard of living. This apparent stability masks a process of shifting risk from the system to the household. For young people, this disparity becomes apparent earlier. Low starting income, high rent, and long-term student debt. Saving becomes a luxury. Decisions like buying a home, starting a family, or having children are being postponed not because of a lack of desire, but because of a lack of actual financial capacity. Meanwhile, for older people, the pressure comes from a different direction. High interest rates increase savings income for some groups, but also increase borrowing costs, insurance costs, and refinancing risk. This divergence isn't clearly reflected in averages, but it shapes very different life experiences. Importantly, the worsening economic sentiment isn't due to people misinterpreting the data. It reflects a reality that macroeconomic indicators weren't designed to measure the quality of financial security in daily life. When family budgets have no room left, each small shock has a greater impact. The discrepancy between data and reality is therefore not a random paradox. It's a result of how the economy allocates costs during a prolonged period of high interest rates. These pressures accumulate slowly, not creating an immediate rupture, but enough to change the behavior of an entire society. And when those changes repeat themselves long enough, they are no longer temporary reactions. They become structural features created by deeper operating mechanisms within the system. To understand why financial pressure is widespread even though the economy is not in a technical recession, one needs to move beyond surface phenomena and look at how the system is allocating costs. This is not the story of a single policy, but rather the overlapping of multiple operating mechanisms at work simultaneously. First, there is the prolonged high interest rate environment. Monetary policy is designed to curb inflation by slowing demand. But its impact is not evenly distributed. Large businesses, which already have access to cheap capital, still have room to maneuver. Meanwhile, households and small businesses, those with short-term, floating-rate loans, bear more direct and immediate costs. Interest rates therefore act as a filter, shifting pressure from the top of the system to the bottom. Alongside this is the financialization of life. Housing, healthcare, and education basic needs are increasingly accessed through debt. As the cost of these areas rises faster than income, the system doesn't adjust by lowering prices, but by expanding credit. Debt, therefore, ceases to be an investment tool and becomes a means of survival. In a context of high interest rates, this means becomes more expensive over time. The labor market adds another layer of pressure. Jobs exist, but real wage growth doesn't keep pace with the cost of living. The shift towards service jobs, the gig economy, and part-time positions increases the number of jobs recorded, but doesn't necessarily improve financial security. The gap between having a job and living comfortably is therefore becoming increasingly apparent. Another less discussed mechanism is the data lag. GDP, inflation, and unemployment reflect the recent past, failing to measure the level of stress accumulating in household budgets. When these indicators begin to deteriorate, the room for adjustment has usually narrowed. The system therefore tends to react slowly to signals from real life. Finally, there are structural hard costs. Housing, healthcare, and education act as hidden taxes not explicitly named in policy, but capable of draining real income. These expenses are not easily cut, do not react quickly to economic cycles, and create sustained pressure even when other variables stabilize. When these mechanisms combine, they create a peculiar state. The economy continues to function, but the household's margin of safety is constantly being eroded. There are no single shocks, only accumulation. And it is this accumulation that poses the risk. When pressure becomes widespread, it doesn't stop at individual households. It begins to spread to small businesses, local communities, and eventually back into the financial system through less noticed pathways. Financial pressure doesn't stop at individual family balance sheets. As it persists and spreads, the consequences begin to appear at other levels of the economy slowly, but with a clear direction. The first point of contact is small businesses. As households tighten spending, industries dependent on local consumption feel the impact most acutely. Revenue declines not abruptly, but gradually. Thin profit margins make it difficult for them to absorb higher borrowing costs, rent, and labor costs. This is where the pressure from daily life rolls back into the production sector. From small businesses, the impact spreads to local communities. Less investment, less hiring, and less service. These changes aren't large enough to shake national indicators, but enough to alter the economic rhythm at the regional level. A sense of stagnation thus emerges even when the overall situation is described as stable. The credit system is also not immune. As household debt rises and financial space shrinks, the risk isn't a single default, but a general decline in resilience. Lenders begin tightening standards, limits are narrowed, and credit costs increase. This process amplifies the pressure on those already under stress. There are groups most severely impacted but rarely featured in mainstream statistics. Long-term renters, facing rising rents but lacking assets to offset them. Gig workers, lacking safety nets and stable incomes. Families burdened with education debt, where past expenses continue to drain current income. These groups don't create an immediate shock, but are where the risks are most deeply embedded. Another risk often downplayed is refinancing. When loans mature in a high-interest rate environment, new costs can exceed affordability. This isn't an immediate collapse, but a gradual contraction, reducing consumption and investment over a longer period. These consequences are difficult to reflect on short-term charts. They don't generate sensational headlines, but they erode the social foundations which macroeconomic indicators need to maintain resilience. When these pervasive signs appear simultaneously, the no recession narrative begins to take on a different meaning. It's not that everything is fine, but rather that costs are being spread out over time and gradually shifted to the least resilient groups. And when that spreading continues long enough, the biggest impact is no longer in the numbers, but in confidence, the hardest thing to measure, yet also the most vulnerable in an economy. In economics, confidence isn't an abstract concept. It's a variable that governs behavior. When confidence declines, decisions change, and those changes can slow down an entire system. When households no longer feel financially secure, consumption becomes defensive. Major decisions are delayed. Risks are avoided. This isn't a pessimistic reaction, but rational behavior in a prolonged environment of uncertainty. And when this behavior occurs on a large scale, it inherently creates drag on growth. It's noteworthy that the erosion of confidence occurs even before the economy enters a technical recession. People don't need an official statement to feel the pressure. They react to everyday experiences, dwindling savings, faster debt accumulation, and a growing sense of unpredictability within the system. Confidence is also tightly coupled with future expectations. When expectations worsen, personal investment in education, housing, or entrepreneurship is delayed. These decisions don't disappear, they are pushed back. But that delay is enough to alter the economic trajectory for years, not just quarters. At the societal level, the crisis of confidence deepens polarization. Groups with assets and financial space are better able to adapt. Groups relying on current incomes face greater risk. Differences in economic experience thus translate into differences in belief in the system. There is no immediate collapse in this narrative. There is no single point in time to pinpoint and name it. There is only a cumulative process, where pressure is distributed over time and according to the tolerance of each group. Therefore, the narrative of the U.S. economy not in recession isn't entirely wrong. But it's also incomplete. It ignores a more crucial question: where is people's sense of financial security heading, and what is the long-term cost of that erosion? The economy can continue to function without breaking. But a society cannot function sustainably if trust is gradually eroded. What remains is not predicting the day of collapse, but the patience of those bearing the daily costs and whether the system can adjust before the social cost becomes too great.